on, guys? My name is RJ and this is the Gen Z Investor channel, where my goal is to change the way investors invest in the stock market. Now, in this video, I'm going to be talking about why you should never buy stock options in the options market if you want to make consistent profits in the stock market. So in this video, I'm going to be breaking down 4 different aspects of why I think that it is not a good idea to buy options and why it is likely that you will end up losing money. Point number 1, the statistics are against you. Now, when you buy options, you are essentially paying a fixed amount for a potentially unlimited upside. So if you were to buy a call option, you essentially are bullish on the stock and you think that the stock is going to rally in the near future and you'll be able to buy the stock at a cheaper price. If you're bearish on the market, you would buy puts, and essentially you think that the market's going to tank and you're going to be able to put that stock to the option seller at a lower price because the stock is trading at below the strike price that you chose. Now, when it comes to the options market, there's going to be some sort of built-in edge to the option seller because they are taking on theoretically unlimited losses, whereas the option buyer is paying a fixed premium for the potential to have a large upside. However, through backtest, we have pretty much proven that historical or realized volatility is likely lower than implied volatility. What this means is that people who buy options are overpaying for those options because the volatility that's priced into those options is higher than what actually occurs when things roll out into the future, and option sellers are able to collect more money than what is actually going to happen in the future. Point number 2, difficulty timing the market. In order to be profitable when you're buying options, you have to be able to predict the directional aspect or directional movement of a stock. And not only do you have to be right directionally, you have to be right the magnitude of the direction within the time that you bought those options at. So let's say that you bought call options on Facebook with strike prices of $200 and an expiration of a few weeks out. Now, Facebook would have to trade above $200 plus the premium that you paid in order for you to be profitable. So not only does Facebook have to move up, it has to surpass the strike price that you chose and the premium that you paid within the allotted time, which we know is extremely difficult to do. And from looking at previous research, most options will end up expiring worthless and you'll end up losing money trying to predict market direction, which we know is almost impossible to do. I myself pretty much believe that markets follow a perfect random walk, and that is actually supported by a lot of academic research on the stock market and market direction. Point number 3, volatility is mean reverting. So one question that maybe some people might ask is that volatility is mean reverting. So what this means is that volatility is going to oscillate between expensive and cheap or high and low, and you know when volatility is low and you know when it's high. Therefore, it may make sense or it may be tempting for you to sell volatility when it's high and then buy volatility when it's low. However, there are 2 reasons why buying cheap volatility or being long volatility when the implied volatility or the VIX is low is not a good idea. Reason number 1 is that you're buying a depreciating asset. Once again, this means that you have to be right directionally on that stock or on that underlying in order to be profitable on that trade, and you have to be right within that specific time frame that you paid for. Additionally, the VIX can actually trade substantially lower. It can stay at levels of like 10, 12 for long periods of time. So you're still gonna have to be able to time the market. So let's say that you are bearish on the market and implied volatility is very low. So what do? You go ahead and you buy put options on the SPY index. Now, the problem with that is that even though implied volatility is low and you have probably a higher percentage chance of winning on that trade, you have no idea when the market is going to correct. Additionally, you have no idea when to take profits. Now, this is a very important point because when you sell option premium, we mechanically close our positions out at around 50 to 65% of the max credit received. However, when you buy options, you have no freaking idea when to cover your position or when to sell back that option. For example, let's say that you are bearish on Facebook. Right now, Facebook's trading at in the 180s. Now, let's say that you buy a put option on Facebook a few months out with a strike price of $155. Now, let's say that Facebook starts to trade down and it moves all the way down to $155, but there's still time value in that option. It doesn't expire for a while. Now, that option that you originally paid for, let's say $1, is now going to be trading for, say, $5. However, you have no idea when to close that position, and it's going to be very difficult to, again, time the closing out of that position, because if you sell something for $1 and it goes to $3, which would be a 200% gain, it's going to be very difficult to close that position out, because in the back of your mind, you're going to be thinking, well, what if Facebook corrects even more and I can sell this option for $10 or $15? So there's a lot of psychological and cognitive biases that come into play, and you just have no idea when to take profits. Again, when you sell options, we close out our trades at about 50 to 65% of max profit, and we don't have to kind of guess where the market's going to go. We just mechanically close out our trades, and we don't have the stress of being like, oh, should I close this out or should I hold on to it longer? Again, price action is pretty much perfectly random. So you just have no idea when to take profits. And you'll hear a lot of these people on YouTube who trade options or do day trading. They always talk about taking profits, taking profits, taking profits. But the reality is that you have no freaking clue when to take profits and when to take that trade off the table, because again, markets are random and you can't guess future price movements. Point number 4, survivorship bias. In this point, I'm going to talk about how people get away with saying that they are profitable when they buy stock options. Again, one of the main selling points of buying options is that you only have to pay a fixed amount of premium, and theoretically you have the potential to make unlimited gains, which is actually kind of a compelling point for people who are new to the market, which essentially draws people or attracts people into not shorting stocks, but to buy put options on stocks that they are bearish on. Now, these stock option gurus will post their winning trades and they won't post their losing trades. I myself see these ads all the time where people will post trades where they make 500, 700, 1,000% gain in one day by an options trade that they made. However, this does not mean that you are going to consistently make those trades, and that will happen a certain percentage of the time. However, again, that does not mean that you're going to consistently make money by buying option and by being a price guesser. So what these people do when they are selling a stock options course and they talk about buying options is they are getting into a form of survivorship bias. So people who make successful options trades only post their winners of the options that they buy, and they do not post their losers. This leads to a false sense of overly optimistic beliefs because failures are ignored and aren't visible to the consumer who's looking to buy this program. This leads to people thinking that they can just buy this guru's course and that they can buy stock options and be profitable in the long run. Another way to explain this survivorship bias is through a roulette example. Now, if you don't know what roulette is, it is essentially a game in a casino where you have a wheel with 38 spaces and you can bet a whole different number of ways. So there's gonna be 36 spaces total where you can make money and 2 spaces where the house is always gonna win. So this is kind of the built-in edge to this game. Now, when you play these games such as red or black or high or low, because the house has essentially 2 spaces where they have their edge, the expected outcome is less than 50%. More specifically, if you were to play red or black or high or low, your expected outcome or probability of profit is only 47.37%. Now, statistically, if you play roulette, there's actually slightly over a 5% chance that you're able to 8x your money. Now, this does not mean that you can consistently make money playing roulette. And buying options is essentially the same concept, where you have a slight disadvantage and you have an expected probability of profit that is under 50%. However, in the long run, your expected payout is going to be negative. What this means is that every time you play roulette, you are essentially going to lose money. Now, this does not mean that you cannot make money in the short run, because again, there's a 5% chance, or around a 5% chance, that you make 8x your money. Additionally, people who make money by these games with negative expected outcomes, or they make a lot of money in games that have negative expected outcomes, they will be more willing to post their results in order to brag about how much money they made in order to fulfill their own personal ego. However, this does not match up with the actual math and statistics about expected outcomes. And it is really a demonstration of the power of survivorship bias in terms of making money in games that, again, do not have a expected positive outcome. Now, in contrast with selling option premium, we are essentially the casino. We have a built-in edge to us, and our expected outcome or payoff is positive. So given enough times that we sell options, or in the casino's case, the more the gamblers play in the casino, the more money that we are going to make. Now, it is possible if you have a small sample size or a small amount of occurrences to lose a lot of money when you are selling option premium. However, the law of large numbers basically states that the larger the sample size or the greater number of occurrences, the average outcome is going to get closer to the expected outcome. So as long as you have enough occurrences and you trade enough, you essentially will be able to capture that positive expected outcome in the stock market. So when it comes to buying options or day trading or trading Forex, expected probability is probably in the low 40s in terms of the win rate. However, there's no chart pattern or there's no information that you can take in order to increase this above 50%. What this means is that all these instruments have a negative expected payout, and the more you trade those products, the higher likelihood that you're going to lose money. Additionally, this is without even factoring in commissions, all the psychological and cognitive biases that you're going to naturally have as a human, and you're really going to be frustrated at yourself when you do not make money and you are consistently losing money. Now, there's people out there, day traders, and even people who are long-term investors who claim that they are the 1%, that they have this special ability that no one else has, and there's only a certain exclusive amount of people who can make crazy amounts of profit in the stock market. However, this is not accurate. Most people who claim to make a bunch of money on the stock market are lying. And if only 1% can make substantial returns in the stock market, then why are you selling a course for the masses? Because the reality is if there was an easy way to make money on the stock market, then everyone would do it, and that would push prices to be even more correct, and there would be even less profits in the stock market. So in summarization, buying options is not a good idea. You have a negative expected outcome or payoff. Therefore, the more options that you trade, the more likely you are going to lose money. Now, hopefully you understand the survivorship bias that I talked about in this video and how it is used to manipulate people who don't know anything about the stock market, how it works, and the probabilities and math behind the expected outcomes of these different financial products. The last thing I want to say is that I myself am an option seller. So what this means is that I am collecting premiums for basically selling insurance on the stock market in order to realize a profit. I believe that this is the only statistical way to consistently make alpha in the stock market. So I hope you enjoyed this video and you got value from this video. Make sure to smash the thumbs up, leave a comment down below if you have any questions, and please subscribe to my channel for more content. Again, my name is RJ. This has been the Gen Z Investor channel. I hope you have a wonderful rest of your day, and peace out.